Welcome friends to the NPTEL MOOC module on international trade theory and empirics. We are on the 11th week of our schedule. In this context, especially in this particular week, we are concerned in explaining the dynamics of foreign exchange market in terms of adjustment, stabilization, and and some impacts like whether it follows a J curve effect or follows any other dynamic path is important discussion in this module. Then this is followed by some two applications we will also unfold in our discussion. These are like optimum currency area we will also discuss, and also we will link it with some Asian countries where the impact is different, or the European or the American economy and its impact, how it affects differently we will also understand. Now, question occurs how the effect of exchange rate changes through price adjustment actually create a kind of change which follows a J curve pattern. What do you mean by this? The adjustment in the current account balance actually reflected a little later, not so quickly. Okay. So, let us discuss this aspect, and how we can go for it will be understood correctly. Okay. So, now first in the introduction I wanted to give you the background of understanding the J curve effect, how it influences things. Okay. Like basically the adjustment is a phenomenon where trade balance of a country worsens following the depreciation of its currency before it improves. So, whenever we have trade balance gets worsened due to the impact of depreciation. So, the impact is initially worsening, but later on it catch ups and improves. So, basically what we are trying to mention in the previous two lectures connecting to the depreciation or devaluation of its currency. As we all know that depreciation is market based, whereas devaluation is officially based, or the government of the concerned country takes the decision to devalue the currency. So, usually when it is market based, we follow a fluctuating exchange exchange rate regime. But in case of devaluation or the pegged exchange rate regime, government can take some decisions in devaluating its currency in order to take more exports, so that as compared to imports, so that our trade balance improves. Now, question occurs here, does it reflect quickly? How quickly it responds? It depends upon two entities together, demand and supply of the domestic country and demand and supply of the foreign country. Now, the responsiveness of changes in both the places is important to note. Therefore, we are concerned in the elasticity of the demand and supply in both the countries for their products with a change in the devaluation exchange rate. Okay. So, generally any depreciation in the value of a currency is expected to improve the economy's overall trade balance by encouraging exports and discouraging imports. Okay. So, generally as I already said that economy's trade balance improves due to depreciation. However, this may not happen quickly because of some of the frictional implications within the country. Okay, like the expectations, the kind of resilience to the changes are different. The country may not respond so quickly. Okay. So, many importers and exporters in the country, for instance, may be locked into binding agreements that could force them to buy or sell a certain number of goods despite the unfavorable exchange rate of the country. Yes, we have already said from the beginning there are lots of binding contracts between two parties, maybe through different assets, assets and its contract. Some of are redeemable in some specified date, some of are redeemable in a future time. Now, even if the exchange rates are favorable or unfavorable, they may not able to respond so quickly. So, that is why we are mentioning here as locked in the binding agreements, all right. Then in the context of this, I wanted to mention that in the goods market model, it is assumed that to understand the implications of devaluation on the balance of payment, we have to have some assumptions. So, like probably I have jotted down together to discuss this, but let me come back to it. That it is assumed that exchange rate that is in this context, as per the example mentioned in the source, I have taken the exchange rate of dollar as against the pound. So, what is that? It is basically dollar upon pound. So, the exchange rate is directly related to current account demand in the United States. Okay. So, this is assumption number 1. Now, second one, the logic of the relationship goes as follows. If the dollar depreciates, like if the dollar value gets lower, okay, that means that means as per the equation, that is dollar upon pound sterling, this increases. Okay. What does this mean? This means the per unit replacement of pound is in terms of dollar is higher and higher, since the value of dollar are depreciated. Okay. So, in that context, foreign goods will become more expensive, because while importing foreign goods to the domestic country, we are supposed to pay higher dollar denominations, okay, or higher dollar value. So, since foreign goods become more expensive to the US residents, since here the concern domestic country is US and the foreign country is UK. Okay. So, now in US the goods are becoming expensive. So, that may cause an increase in the demand for US exports, not imports. Okay. So, exports will rise and there will be demand, import demand will fall, because now while importing from other country, the value of import actually is becoming higher because of the dollar gets depreciated. So, with the same logic, what will also mention that US goods will appear relatively cheaper to foreign residents, okay, and thereby that will eventually lead to higher US exports. So, the exports of US increases and imports of US decreases. So, this is implying favorable current account balance, all right. So, current account improves. So, the increase in export demand and decrease in import demand will both contribute to an increase in the current account demand. This is what I have already mentioned. Okay. Now, since in the goods market model, any increase in demand results in an increase in supply to satisfy the demand, the dollar depreciation should also lead to an increase in actual current account balance. Okay. So, that means in the goods market we are referring, because we are concerned in export and imports at this moment. In the goods market model, any increase in the demand results in an increase in supply to satisfy the demand. The dollar depreciation should also lead to an increase in the actual current account balance. So, there will be increased supply in the country, that lead to the improvement in the actual current account balance within the country. All right. Then second one is important to note is that the J curve which we wanted to mention here, that is somewhere attached with asymmetric J curve, because it is not symmetric, the changes are not symmetric, not so smooth, because the responses are by magnitude is different. And so, the J curve implies that there could be an asymmetric relationship between the exchange rate changes and trade balance. Okay. So, the impact of exchange rate may not be smoothly tends to a J curve phenomenon. So, current account balance may not be smooth. All right. So, current account changes, current account balance and its change is not symmetric. The asymmetric effects of real exchange rate on trade balance were initially reported by American economist Motion, Bahmani and Uskui from the University of Wisconsin and Milwaukee. Okay. So, so these three economists, the Bahmani and Uskui and Motion from the University of Wisconsin reported about this asymmetric effects. Okay. So, asymmetric effects is noted and to be emphasized. However, the term asymmetric J curve was coined by asymmetric J curve was coined by the British economist Muhammad Ali Nazir and Mary Leung. Okay. So, two economists who coined this term called J curve effects, okay, which has connections with exchange rate and current account balance. They employed cumulative dynamic multiplier analysis and reported empirically evidenced figures on asymmetric J curve in an article on trade US trade deficit. So, so they employed CDF, cumulative dynamic multiplier analysis, CDMA. The cumulative dynamic multiplier analysis actually resulted the asymmetric changes. All right, and they plotted the US trade deficit to explain the asymmetric J curve analysis. All right. Now, in real world economies, however, analysis of the data actually explain that in many instances a depreciating currency tends to cause at least a temporary increase in the deficit rather than predicted decrease. Okay. So, the trade deficit in the due to the depreciating currency actually temporarily increase the deficit rather than predicted decrease. So, current account deficit is in current account balance is in unfavorable condition for a temporary period as per the real world data, and that has been suggested by different articles. Okay. That there will be a temporary increase in the deficit or unfavorable balance of payment for a short period. Now, the explanation for this temporary reversal of the cause and effect relationship is actually called J curve theory. Okay. J curve theory actually explains the reversal of those cause and effect relationship between what is that exchange rate and their changes and its implications on current account balance. All right. So, basically that is a temporary reversal of the cause and effect relationship. So, not necessarily that is explaining the final or perennial changes. So, in terms of future use of the aggregate demand model, and we will always assume that the J curve effect is not operating, okay, in terms of future use of that model, unless otherwise specified, unless otherwise it is specifically mentioned for a time period, it may not be eventually considered for a long period and changes are not going to be perennial. One should think of this effect as a possible short-term exception to the standard theory. Standard theory suggests that with the reduction in the decrease in the exchange rate or the value of a currency, when there is a depreciation or devaluation of a currency, that will lead to or that leads to increase in the balance of payment or balance of or current account balance at least, but actually J curve effect denies that. J curve theory explain exceptions, especially a short term exception to the standard theory. Okay. So, short term is quite important to take a note. It is also called a reversal relationship, and this has been evidenced by data. Okay. The theory of the J curve is an explanation for the J like temporal pattern of change in a country's trade balance in response to a sudden or substantial depreciation of the currency. So, it is like a J like temporal pattern. Okay. So, J is like this. So, it initially falls, the current account initially falls, then respond in a upward movement in a later stage. Okay. So, J curve explanation explain the temporal changes, basically it is over time period and its implications. All right. So, now coming to the J curve impact, as we already said, now exchange rate is if it is depreciated as explained here in the diagram, it has initial implications with a negative trend, okay, to certain time period. Now, after that it gets pick off and gets adjusted and resulting following the suggestions of the standard theory. Okay. And so, but look at the time period, this is T1 and this is T2. Okay. Now, in T1 the decision was taken to depreciate the currency, that is here we have taken the currency dollar in terms of dollar against 1 unit of pound sterling. So, this is basically the exchange rate of US, okay, US exchange rate. All right. Now, so when at T period, T1 period the decision was taken, or it automatically due to the market forces the value of the currency depreciated, but it does not quickly respond, it took some time. Okay. In another time period it started responding with the expectation that that might fall further. Okay. Or there might be improvement further, since the exchange rate reduced, the countries might be having some other expectations. So, that expectations actually reduces the current account balance. Okay. But rather okay. So, let me read out the exact changes. So, depicting two variables measured hypothetically over some period, the US dollar or pound exchange rate, the US current account balance is explained in this particular diagram. So, current account here we are referring, and this is from one source I think I have quoted from the beginning. this diagram is explaining current account balance, then exchange rate. On the left hand side we have taken exchange rate, on the right hand side we are referring to the value of current account balance. On the horizontal axis it is time, okay, over the period of time what are the changes. Therefore, we are referring to the intertemporal changes. The exchange rate is meant to represent the average value of the dollar against all other trading countries' currencies and would correspond to a dollar value index that is often constructed and reported. Since the units of these two data series would be in very different scales, we imagine the exchange rate is measured along the left axis. This is what I have said, while the current account balance is measured in different units on the right hand axis. Okay. So, since the units are different, so we are putting it in different axes. So, with appropriately chosen scales, we can line up the two series next to each other to see whether changes in the exchange rate seems to correlate with positive or negative changes in the current account balance. So, at what time it is positively responding, what time it is negatively responding, you can check the difference between these two. Even if exchange rate is stabilized, but still there are implications, but the stability in the current account balance comes little later. Okay. Now, coming to the interpretation further, that as previously mentioned, the standard theory suggests a positive relationship between exchange rate and US current account, implying that keeping other thing constant, any dollar depreciation should cause an increase in the current account balance, alright, or rise in increase in exchange rate lead to increase in the current account balance. However, what sometimes happens instead is actually immediately following the dollar depreciation at period T1, the current account falls for a period of time until T2, and T2 is actually reached. T2 refers to time period 2. In this phase, a current account deficit would become larger and not smaller. Okay, so, that is to be noted. I have already explained with the help of diagram. Eventually, after the period T2, the current account balance reverses direction and begins to increase. That means, there will be a trade deficit falls, okay, or trade deficit actually falls. The diagram demonstrates clearly how the current account balance follows a pattern called J, in J. In the transition following a dollar depreciation. Hence, the name is defined as J curve theory. Okay. And now, in the real world we have already cited, once again we are mentioning based on the diagram that the period of time though necessary for the current account balance to traverse the J pattern between 1 and 2 years, okay, 1 and 2 years. However, this estimate is merely a rough rule of thumb. It is not to be considered true always, as the actual path will be influenced by many other variables and their changes that is occurring at the same time. So, instead of keeping all other factors constant, these two may not impacting, and the result may not follow the the way we have explained. Indeed, in some cases the J curve effect may not even rise. So, there is nothing automatic about it. There may not even rise also rising trend. So, it is not automatic, alright. So, it is more or less a rough approximation and presented by different authors in their papers. Okay. The reasons for the J curve effect can be better understood by decomposing the current account balance. Okay. The exact reasons could be actually decomposed, then we can attach the factors behind the changes. The basic definition of current account is the difference between the value of exports and the value of imports. The J-curve theory recognizes that import and export quantities and prices are often arranged in advance and set into a contract. Okay. For example, an importer of watches is likely to enter into a contract with the foreign watch company to import specific quantity over future period. I think this is what we have said. Okay. So, usually there are lots of contracts between two parties or two countries, and those are made in advance. So, like example we are mentioning for watches, they had the contract with the foreign company to import a specific quantity over future period, but the price of watches will also be fixed by the terms of contract. Such a contract actually provides assurance to the exporters that the watches that the country makes will be sold in that specific period as per the contract. This provides assurances to the importers that the price of watches will remain constant. Contract lengths will vary from industry to industry and firm to firm, but may extend for a long as a year or more depending upon the contract they followed. So, what we wanted to mention in these cases, these are these may violate to the J curve pattern and may not be responding correctly as per the explanation we have made. So, it is a long phrase I am deliberately reading out so that the most important point might not be lapsed. The implication of contract is that the short run, perhaps over 6 to 18 months by some of the authors, both the local prices and quantities of imports and exports will remain fixed for many items, okay, as per the contracts. Implications of, we are actually referring to the contracts. So, the local prices and quantities in terms of price and quantity may be fixed. However, the contracts may stagger in time, that is, they may not always be negotiated and signed at the same date in the past. There might be some exception. This means that during any period some fraction of the contracts will expire and be negotiated. So, renegotiated contracts can adjust prices again. If there will be new renegotiated contracts, then the price and quantities may respond to the changes in the market condition or as per the exchange rate. Such as change in the exchange rate, as I just said, this in the months following such a change in the exchange rate, this in the months following a dollar depreciation, contract negotiation will gradually occur, causing eventually but slow changes in the price and quantities traded. So, if renegotiated contracts are there, that will gradually follow the path we explained. With these ideas, as we explained right now, let us consider a depreciation of dollar in the very short run, say during the first few weeks. Most of the contract terms will remain unchanged, meaning that the prices and quantities of the exports and imports will also stay fixed. That is why even if it is depreciation is followed, it does not reflect so quickly in terms of the current account changes. The only change affecting the current account formula then is that the increase in the exchange rate, assuming all imports have not been hedged their trades by entering to forward contracts, so for the increase in the exchange rate will result in immediate increase in the value of imports measured in terms of dollar. Okay. So, if any hedged in the forward market is there, then there will be some responsiveness. Since the prices and quantities do not change immediately, the current account balance falls. Okay. That is what can account for the initial stage of J curve effect, which we have already emphasized between the period T1 to T2. Okay. Now, as the dollar depreciation continues and as contracts begin to be negotiated, traders will adjust quantities as per the demand again. Since the dollar depreciation causes imported goods to become more expensive to US residents, the quantity of imported goods demanded and purchased will fall. Similarly, exported goods will appear to be cheaper to the foreign goods. So, as their contracts are renegotiated. Okay. Once again I am emphasizing, once it is renegotiated, then it has implications in the current account balance. The changes in this quantity will both cause an increase in the current account. So, thereby decreasing the trade deficit. Thus, as several months and year pass, the effects from the changes in quantities will surpass the price effect caused by the dollar depreciation, and the current account balance will rise as shown in the diagram in time period T2. Okay. So, I am mentioning everything together in order to highlight that how the logic follows and its implications actually connected to the J curve. So, therefore, it is worth noting that the standard theory which says that a dollar depreciation causes an increase in the current account balance assumes that the quantity effects, that is the effects of depreciation on exports and import demanded, are the dominant effects as per the standard theory. So, on the quantity effect, so they mention that there will be dominant effect of the quantity. Okay. Jacob theory qualifies that effect of suggesting that the quantity or demand effects will dominate. It may take several months or years before becoming apparent. So, this quantity effect and price effect on the previous slide we mentioned that so in another period that will actually surpass the price effect. Initially price effect is dominating, but later on quantity effect actually dominates the changes. So, in a nutshell, I just wanted to mention we have learned that price effect and its adjustment, okay, and quantity effect and its adjustment, then and accordingly there will be change in the current account balance. And so, J curve which you have already shown is reflected accordingly, and there might be further balance in the long term. All right. So, you have please take a note, there might be questions based on this logic we have presented. Besides that, I do not think we can stretch it further, and we will carry forward discussion with other important examples in the next class. Thank you.